All right, welcome back to another edition of Financial Accounting. Before I jump into Chapter 3, just a couple announcements. You should have received an email from me last Friday regarding the push of Homework 3.4 to Sunday. So I plan to talk about 3.3 on Wednesday. We may not have enough time to get through all of 3.4 on Wednesday, but Homework 3.3 will definitely be done on, need to be done on Thursday. So please make sure you budget enough time to do that because that sucker is a bit of a doozy. Um, Also, you all did very well on the exam from the previous week. Realize we have another exam coming up here in a couple weeks, so you want to make sure that you keep the pedal to the metal, as they say. Also realize that if you did well on exam one, please realize that exam one tends to be the easier exam. This stuff gets pretty dense as we go. So you want to make sure that you are reading before you come to class. You want to make sure that you are filling in your notes while you are in the class session. You want to make sure that you are completing your homework on time. And you want to make sure especially that you're asking me questions as you need help. Now for that, we will jump into Chapter 3. 3.1, we need to, before we jump into some of the details about the adjusting journal entries that we have to do, we need to understand the purpose and the rationale for using accrual basis accounting. Accrual basis accounting is the fundamental form of accounting that we do in this class, and it differs from cash basis accounting significantly. So to give you an idea, cash basis accounting, we record transactions whenever cash is spent or received. So if we're talking about cash that is spent, we would record a journal entry that credited cash and debited, say, some type of an expense. If we recorded a transaction where cash was received, we would debit cash and record whatever the credit may be, such as maybe it's a note payable because we borrowed cash. Either way, the only time we record a journal entry is when cash is spent or received. So there will always be, under cash basis accounting, a debit or a credit to cash. Accrual basis accounting, we record the transaction whenever a transaction occurs. What does that mean? Well, generally it means some sort of economic event or movement or change in our economic circumstance. So if we earn revenue, we will automatically record that revenue regardless of whether or not cash is received or not received. So accrual accounting is more fundamental in the sense that, not so much fundamental, but more robust in the sense that it records both cash and non-cash transactions. We want to be more thorough with our accounting. That's why accrual basis accounting works for us. It does not matter if cash was spent or received. We will record a transaction regardless of whether or not cash was spent or received. GAAP, generally accepted accounting principles, requires use of accrual accounting. So it's a bit of a beast, but the reality is if you know accrual accounting, any other type of accounting is generally easier from there. Pros and cons of cash basis versus accrual basis accounting. Under cash basis accounting, why would somebody use cash basis accounting? Well, it's simpler. There's only a few transactions you need to remember to record. If cash moves, record a transaction. A lot of small businesses tend to use cash basis accounting because it's simpler. Plus, accrual accounting requires a little bit further knowledge about economic events, such as when to record expenses and revenues, even when cash does not necessarily move in those transactions. The downside of cash basis accounting is that it leads to financial statements that are misstated. That's generally a big no-no because we don't want to misinform our investors. It also has a tendency to ignore the financial impact of important information. So for instance, if we're involved with a lawsuit, we may not pay out any cash related to the lawsuit. Maybe we expect to lose the lawsuit, but generally speaking, if we're cash basis, we won't record anything until cash is actually paid. Is that a bad thing if we know we're going to have to make a huge payout because of a loss from a lawsuit? Probably. So that's one of the things that's a downside about cash basis accounting, is that it potentially misleads investors because it does not provide complete information. The only time we record a transaction is when cash is actually spent or received. So it leaves a lot of stuff out. Accrual accounting records everything, but primarily it records not just cash transactions, but any transactions where there's revenue that's earned or expenses incurred, regardless of whether or not cash is being spent. And this is nice because it continually updates our financial system in real time. So if we're using accrual accounting, we can produce financial statements and trust that all the information that we're seeing in the financial statements is updated in real time. Another benefit, all relevant information is included in the financial statements. There's not going to be anything missed out when we're using accrual accounting because we're not hindered by this notion that cash has to move around. It does not matter if cash was spent or received. We will record things if there's an economic impact, period. The primary downside, and really, in my opinion, the only downside, is that accrual accounting requires more journal entries than cash basis accounting. So imagine a situation we saw in last chapter where we perform services on account. So yes, we earned revenue and we would record revenue as a credit. If we didn't get cash, we would go ahead and record an accounts receivable of that same amount. That would be one journal entry under accrual basis accounting. Later on, when we collect the cash, we would credit away the account receivable. We would no longer have that amount owed to us from customers, and we would show a debit to cash for the amount we expect to see. Accrual basis accounting would require us to do two journal entries, whereas cash basis accounting requires essentially only record cash and the revenue when the cash is received. Therefore, only one journal entry. So yes, accrual accounting requires more information, but it's much more accurate. Why GAAP? Well, accrual accounting records both cash and non-cash. Cash transactions you're probably familiar with already. It's the collecting of cash from customers or from interest earned. It's the paying of salaries. It's the paying of rent. It's the borrowing and paying back money from a loan. It's the issuing of stock for cash. Anytime cash moves, we'll capture that. But we also capture the non-cash transactions, which is really the more important part of accrual accounting because we can make a sale and earn revenue if we sell to customers on account, meaning that we record an accounts receivable. We can also record purchases on account, meaning we would use accounts payable to reflect the fact that we didn't pay cash, but we definitely owe some amount to the vendor or the supplier. We'll record that. We may have to accrue a liability, meaning that even if we have to make an estimate of an expense that we have incurred, like our lighting, we will record that expense and that liability even though cash was not paid. Usage of assets, and we'll talk more about this, especially when we talk about fixed assets. Depreciation, the acknowledgement that the value of our equipment, like our computer or our vehicle, decreases in value over time because of use. We will record an expense for that, even though we know we're not paying out cash as the expense is being incurred because, hey, if we bought the computer, we already paid cash. Maybe we paid cash a year ago, 2 years ago, 3 years ago. That cash has already been spent. But the expense happens little by little by little over time. That's why non-cash transactions become so important to keep track of. We'll talk more about these as we go throughout the term, but you'll kind of get the idea as we go through some of these examples here shortly. The thing you need to know about accrual versus cash basis accounting is that there's really only a timing difference. Ultimately, theoretically, all cash basis transactions equal accrual basis transactions as long as we give enough time for the cash to settle out. It's a timing thing. Sometimes cash comes later, after the event, sometimes it comes before the event. But given enough time, cash, accrual basis accounting, eventually cash will move, it will all be settled out, and accrual basis accounting effects will equal cash basis accounting effects. In other words, it'll have a similar impact on the income statement or the balance sheet. If financial statements did not have to be issued on a regular basis, then it would not matter whether or not we use the cash basis or accrual basis accounting. However, we must produce financial statements at regular intervals, and that's called the time period concept. When we produce financial statements in chunks covering certain specific periods of time at regular points of time in the future. You may be familiar with this time period concept as is. When you file your tax return, you're submitting a tax return every year to the IRS. The IRS wants to know, hey, between January 1st and December 31st, how much money did you make? Because we want some of that. So you already do the time period concept. You already file an annual statement with the IRS. It's an income statement. The basic accounting period, therefore, is also 1 year or 12 months. We will produce financial statements that cover 1 year. Potentially it's January 1st to December 31st. That will be a chunk of time. And we start over the next year, that January 1st, and we'll go to that December 31st, and on we go. Sometimes you see that companies will provide information every 3 months, 3 months, 3 months, 3 months, because investors want to know on a more regular basis what the heck is going on within the company. Those type of financial statements are called quarterly financial statements because they're issued every 3 months. So 3 months, 3 months, 3 months, 3 months, that's 4 quarters in 1 year. One thing to be aware of is that when you're determining when to start your fiscal year, that is, do you want to start on January 1st and go to December 31st, or do you want to start sometime in the middle of the year? You can decide that. So we're not restricted by sticking with just January 1st or December 31st. We can go, say, from July 1st of 2019 to June 30th of 2020. Microsoft, believe it or not, has that fiscal year period. And it's nice, especially if you're an auditor or a tax accountant, because if your clients have a staggered year end, it doesn't mean all your work is crunched during the tax season. The year end cutoff, why time period concept matters. You have to realize that at the end of the year, companies must do a process called closing the books. We'll get to that later on, the process of how it's done. But it's a very, very, very important process because we need to make sure at the end of the year, at the end of the fiscal year, all transactions from the previous 12 months have been recorded and are inputted into the accounting system. We don't want to include any transactions prior to January 1st, the start of the year. We don't want to include transaction effects after the end of the current year. We want to keep it within the borders. When we produce the 2020 financial statements, we want to make sure that our income statement only shows revenues and expenses from 2020 only, nothing before, nothing after. Statement of retained earnings is going to show net income and dividends from 2020 only. Yes, beginning retained earnings is carried over from last year's ending retained earnings, 12/31/2019. But that's just the starting point. What we see after beginning retained earnings are net income for the current year 2020 and dividends for the current year 2020. So the ending retained earnings balance includes everything from 2019 and prior through this current year, but it's only updated once per year with the current year's activity. On the balance sheet, the assets, liabilities, and equity, you see that is the December 31st balances as a point in time only. So how much cash do we have at the end of the fiscal year, December 31st, 2020? This is how much cash we have. Here's how much land we have. Here's how much we have in common stock, in debt, etc. Some companies may also show, for comparison reasons, the prior year-end balances. So we can see how did cash balance compare relative to last year. Accrual accounting is much better at reporting than cash basis accounting because it's far more accurate. It includes things that cash basis accounting would potentially ignore or miss. To give an example of the differences between the two, consider the following economic transactions. Assume in these 4 examples, you'll see the company has a December 31st fiscal year end. That means their year that they measure themselves, the fiscal year, ends on December 31st. So it goes from January 1st to December 31st. Assume that a utilities bill was received at December 31st, 2020, and it includes all the utilities up through December 31st, 2020. We decide as a company to pay the bill 5 days later in the next fiscal year. What does that mean? Well, in accrual accounting, once we figure out how much we owe, we're going to go ahead and record the expense. It doesn't matter that we pay it in 5 days. We're going to go ahead and record it right now at December 31st, 2020 as an expense. That's a key thing. We're not paying in cash, so what's the credit? We're just going to reflect the fact that we owe an amount to our utility company. It could be accounts payable, it could be utilities payable. It's a liability, it's not cash. Cash basis accounting, what would we do once we got the bill? Well, if we got the bill, we didn't pay for it, we're not going to record anything until we actually pay cash. Well, when did cash get paid? It got paid in 2021. So 2020, this is December 31st. We get the bill in 2020, but we don't pay it until 2021. Guess what? That's where the expense shows up. It's in the next year, but we know it relates to the prior year. That's why cash basis is inferior and accrual accounting is superior. So if we're using cash basis accounting, what's the problem? We're going to see in 2020 that our expenses are going to be too low. We should have included the bill in 2020. We didn't. So expenses are too small in 2020. They're going to be too big in 2021. So if revenues are normal, but expenses are itty bitty, we're going to have really big net income. Net income is going to be too high. It's going to be overstated. You get overstated net income, you're going to get overstated ending retained earnings, overstated stockholders' equity, et cetera, et cetera. Mistakes kind of permeate all the way through, so make sure you pay attention. Example 2, the company has a December 31st fiscal year end still. Now, in this situation, the company is going to prepay its 2021 rent on December 31st, 2020. So we're at 2020, Dec 31. In 2021, we're going to use warehouse space or office space. We're going to prepay this rent right now. Here's the problem. We haven't used any of the rental space because tomorrow hasn't happened yet. We will start using the rental space starting on January 1st, 2021. It's currently the day before, December 31st. What do we record? Well, if we're paying cash, go ahead and credit cash. But in this case, we're going to debit not an expense, we're going to debit another asset called prepaid rent. That's going to be a short-term asset, like supplies, like inventory, like accounts receivable. It is a prepaid expense, but we call it an asset because why? Because it provides a future economic benefit. In other words, we're paying cash, taking that asset, shrinking that down to get a new asset called prepaid rent. Take one asset, exchange it for another, called prepaid rent. Have we used any of that rent yet? No, we haven't. So there's zero effect to total assets. If we're cash basis, because we paid the cash on December 31st, 2020, a cash basis accountant would go ahead and record the full amount of expense in 2020. That's wrong because no expense has been incurred yet. That expense is going to be incurred in 2021. But because we're cash basis people, we're going to go ahead and record the expense right now in 2020 when we pay it out. So imagine revenues are fine. We have this huge expense, which means we have itty bitty net income. Expenses are too high. Net income, therefore, is too low. Retained earnings is too low, et cetera, et cetera. Things are really looking messed up when you're a cash basis person. Example 3, service revenue was earned at December 31st, 2020. Accrual basis says you earned it, you record it right then and there, regardless of whether or not cash is paid or cash is received. Cash is received actually 5 days later in the next year. What does that mean for us? If we're accrual basis accounting, no problem. We'll go ahead and debit accounts receivable. They'll pay us later. That's fine. The key thing about accrual accounting is we need to recognize the revenue right now. Revenues and expenses are the driver. We have to be aware of that. Cash basis accounting says don't record any revenue until you get the cash, which is wrong because we earn the revenue in 2020, not in 2021. Nevertheless, a cash basis accountant would say, hey, you received the cash in 2021. That's 2021 revenue. Really? So in 2020, if we don't record the revenue, that means revenue is really, really small. Expenses being normal means that net income is itty bitty. So revenues are too small, net income is too small, we've got retained earnings that is too small, and so on and so forth. Example number 4, let's assume that we're a church. Bunch of people planning on getting married next year during June. Currently it's December 31st. Y'all need to make some deposits if you want me to reserve the day. So let's assume I am the owner operator of a church. People start paying me a deposit ahead of time. That's cool. I get a bunch of cash right now for services to be performed in the future. What do? Well, in accrual accounting, we go ahead and acknowledge that we got the cash. That's fine. But we don't credit revenue yet because we haven't performed the revenue services yet. So what we're going to do is record a liability. And this is a weird sounding account, but it's called unearned revenue, meaning that Hey, we haven't earned that revenue, therefore we owe something. This liability means we either owe a service or guess what? We owe the cash back to the people who made the deposit. Either way, you give me cash up front. If I haven't earned it yet, I owe you that money back. So that's what unearned revenue represents, a liability for services to be performed or goods to be delivered in the future. If I'm cash basis, what's the wrong way of dealing with this? It means that I got cash on December 31st, 2020. I'm going to record service revenue, which is wrong because services aren't going to be performed for another 6 months. Nevertheless, a cash basis account would go ahead and record huge revenues. With normal expenses, you're going to get huge net income, meaning overall revenues are too high. Net income is too high. Retained, overstated. Retained earnings is too high. Stockholders' equity is too high, and our liabilities in this case are too low. We should be recording a liability for that money that we owe back to people if we don't perform the service. Same thing when you repay your rent to your landlord or your property manager. You pay at the beginning of the month. Guess what? Throughout the entire month, they owe you access to your apartment or your house. If they don't give you access to your apartment or your house, they owe you your money back. So for them, when you prepay your rent, it shows up as cash in their cash account. But in their financial statements, it needs to show up as prepaid rent. Unearned revenue is what they should see. They haven't recognized the revenue until it's earned. For you, it's prepaid rent. Caution, book value does not equal market value. This is just something to be aware of because a lot of people tend to ask me, hey, you know what? This whole notion of what values we see in the financial statements, is that the same thing as how we measure a company's worth? It's not. Book value is the values that we see in the balance sheet. Market value is usually based on some sort of notion of fair value. Because we're historical cost basis accountants, when we record information and we report information, those numbers are based off of transactions that happened in the past. We don't automatically update the numbers at the end of the year based on their fair value. That's not what we do. So what we see for inventory and supplies and equipment in our financial statements is based on historical cost. So we call historical cost values book value because why? Because we're the bookkeepers and that's the value we see in our books. Historical cost does not represent what's called liquidation value. And liquidation value is another phrase for saying, hey, look, if I sold my car right now, how much cash would I get for it? That's liquidation value. Hey, I have a bunch of debt. How much cash would I have to spend to get rid of this debt? That's liquidation value. Sometimes it's referred to as market value or fair value. But just realize that when we look at the balance sheet, we're not seeing inventory at market value or fair value. We're seeing book value. So the only true way to really measure the values that we see in our financial statements is to sell all those things or settle off all of our debts immediately. Fair value is realized at a point in time when it actually happens. That'll be important to know as you see later, like when we determine how much in revenue we record. So hold on to that thought. To give you a comparison between cash basis and accrual basis accounting, I want to give you a set of journal entries here. So imagine on 9/1, September 1st, we earned revenue and $800 in cash is what we received. Fair enough. What would we see under cash basis accounting for a journal entry? We would see a debit to cash of 800 and credit to revenue of 800. That's fine. What would we see under accrual accounting? The exact same journal entry. Why? Because revenue was earned at that time, and at that very point in time, we also got cash. It's an ideal situation. Give me cash as I earn that revenue. But what if I earn $800 on account? Someone says they're going to pay me back later. What does that mean to me if I'm a cash basis person? Excuse me. There's no journal entry. If I'm cash basis, I don't record any type of journal entry until I get cash. But if I'm accrual basis, I'm going to record revenue for the full amount that I've earned, damn it. That's the driver. It's the revenue, it's the expense. That determines whether or not I need to record something. Whether or not I got in cash or have to record a receivable is kind of irrelevant. In this case, I didn't get cash, so it must be receivable. But the most important thing to realize is the reason why we have to record something is because revenue was earned. So we will record revenue. Now, that might not seem too bad because, hey, Later on, we'll get the cash. But what if we don't get the full amount of cash right away? What if we only get $500 of the $800 we're owed? A cash basis accountant would record revenue of $500. The real revenue was $800. Why are they recording only $500 in revenue? Because cash was the driver for that journal entry. A lot of small businesses get in trouble this way because they use cash basis accounting and they fail to collect the full amount that they're owed from people that owe them money. What if I am accrual basis? Fine, I'm going to record the debit to cash for $500 and I'm going to reduce accounts receivable. But overall, if I am an accrual basis accountant, assets equals liabilities plus equity, I can see that, hey, overall, my assets increased by $800. Some of that was collected in cash already as $500. The other amount, $300, is owed to me. That's a receivable. But overall, assets have increased by $800. On the other hand, if I'm cash basis, how much of assets actually increased? Only $500, which seems weird, but that's all the cash I've actually received. So what's the difference? It's the economic value. Overall, the true amount of revenue, which has increased my overall equity, is $800. Under cash basis accounting, I'm sort of $500. I'm sort of shorting myself $300. I should be showing $800 in revenue. I'm only showing $500 because it's the cash that's driving the transaction, not the revenue. The revenue under accrual accounting, the revenue value is driving the transaction. What if I buy inventory and I pay cash for it right then and there? There's no real difference in the journal entries between cash basis and accrual basis accounting. But what if, in this case, I buy $200 worth of, say, lumber from my supplier on account? I'll pay my supplier back later. In the meantime, I'm walking away with $200 worth of lumber. Okay? If I'm cash basis, there's no journal entry because I didn't pay any cash. Nevertheless, I'm walking out the door with $200 worth of lumber. It seems kind of weird not to record something, right? Under accrual basis accounting, it says, look, if you got $200 worth of value, that's what you got. Record what you gave. In this case, I didn't give cash, I gave a promise. So it's not cash that's driving the transaction under accrual accounting. It's the exchange of value. I got $200 worth of something. I gave $200 worth of something. My promise, my word is worth $200. What happens when I pay out $150 off of that amount I owe? Under cash basis accounting, I would only record inventory of $150. That doesn't make any sense. I got $200 worth of inventory, but on my books, I'm showing $150. Why am I only showing $150 of inventory if in actuality, I have $200? It's the cash. The cash is driving that transaction. It's not the real value that was exchanged. It's just the cash that's determining how much the value is. Under accrual basis accounting, when I pay off $150 worth of my accounts payable, the accounts payable goes down. But ultimately, what do I see as the change in the accounting equation? I see that there was a net increase of $50 in assets. How did that come about? Well, there was an increase of inventory, $200, and there was a decrease in cash of $150. So I got $50 net increase in my assets. But we're not done yet. I have to also show the fact that there's $50 worth of liability. I owe another $50 to the supplier. And I better make good on that, otherwise my supplier's going to cut me off. Under cash basis accounting, what do I see as the effect to the accounting equation? Nothing. I see that there's zero effect. In other words, we see that inventory went up by $150. We see that cash went down by $150. So there's zero net effect. But in actuality, I got $50 worth of assets net. I also owe debt of $50. Another example here. During 2020, let's assume I owe the bank $125 worth of interest. Fair enough. Let's assume up until December 31st, I've paid off $100 worth of interest during the year, and I owe another $25 in January of next year. A cash basis accountant would go ahead and record interest expense of just $100. Because why? Because it's the cash that's determining that recognition. But if I'm accrual basis, I know it's really the expense that's driving. The expense amount that I've actually incurred is what's driving the journal entry. I've actually incurred 125. The real question is, in this case, how did I pay for it? Well, I paid off 100 of it, and I owe another 25. So down below, you can sort of see that under the accounting equation, a cash basis person would see a decrease of 100 from cash and a decrease in equity due to the expense of 100. But that's not really happened. What really happened was I paid for sure $100, right? And I incurred a liability for the remaining portion that I owe. I better remember that. That's why accrual accounting matters. Don't forget to pay your banker. And I also need to reflect the fact that there was an overall decrease in my equity because of $125 worth of interest expense. The net effect to the right side, of course, is a net decrease of 100, which matches the 100 decrease in assets. That's far more appropriate to record. So what's driving all this on the accrual side? It's recognition of revenue and expense. There are certain rules we have to follow under accrual accounting. Even though cash doesn't move, there's potentially some rule that says we need to record a journal entry nonetheless. That's where revenue and expense principles come into play. They're extremely important. Under the revenue recognition principle, we figure out when to record revenue and how much to record based on certain principles, certain rules. Specifically, when it comes to when we record things, we record revenue whenever services are performed. I'm finished cutting your lawn, or goods are delivered. Hey, I handed over the keys to the brand new car you bought. Those things indicate that revenue has been earned. We record revenue when it's earned. Doesn't matter when cash is received. If we've earned revenue, we record it. Figuring out the other part of the journal entry is just a matter of, was it cash or a receivable? How much revenue to recognize is usually based on the fair market value of what was exchanged at that time. Services performed, the goods delivered. So if we're talking about, hey, I agree to provide you services, cut your lawn, if you agree to pay me cash, mow lawn. At that time, whenever you pay me and whenever I accept, that's considered the fair value of that service at that time. It could be the same amount we charge our customers for same size lawn, but at the end of the day, it represents the fair value. Expense recognition, we record expenses when they are incurred. Expense recognition is also known as the matching principle. Generally speaking, it means that when an expense has been incurred, means an expense has happened to us. Hey, I flushed the toilets today. Hey, I called long distance. Hey, whatever, I've incurred expenses, I've used services, I've purchased goods. It means I will have to pay cash later. It means in the meantime, an expense has been incurred. It's happened to me. I will have to pay cash later. That's fine. But that expense needs to be recorded right now. So the expense recognized typically relates to the revenues in a business. So if we go back to a business where we earn revenue, the question comes down to this. Did it cost me anything to actually earn that revenue? I mean, you think about it. If you mow lawns, you probably have to pay yourself a wage for the hours you work. You have to pay for gas to get your car over there, put gas into the mower, etc., etc. There are expenses being incurred. You probably have a phone bill that you'll have to pay at the end of the month. There's lots of expenses when you're in a business, but the bottom line is you cannot make money unless you spend money. And that's where the expense recognition principle, the matching principle, comes into play. It says, look, if you spent money to earn that revenue, you need to record that expense. You need to match the expense with the revenue. In other words, you're not going to see an income statement that shows only revenue. You may see an income statement that shows nothing but expenses and no revenue. Hopefully that's not the case. But you'll definitely see revenue with expense all the time because everybody knows it takes money to make money. So we're going to recognize expenses when they're incurred because indeed we're always incurring some type of expense, even if it means some sort of salary or wage that we pay ourselves or our employees as they're doing work with us. And it doesn't matter when cash is paid. So on the income statement, another way to look at this expense recognition principle is when you look at the income statement, you know that expenses are subtracted from revenues to determine net income. But what does that net income really mean though? Net income, think about net income like this. Net income represents money earned minus the money used to earn it. In other words, we want to show net income, an amount that represents what it took out of our pocket to pay to earn that revenue. That's what a good income statement is. It's not revenue and no expenses. That doesn't make any sense. So when you think about the money used, think about cash that we paid or some other asset that we consume. We'll go through several different types of journal entries that recognize expenses, and there's lots of expenses out there. But the bottom line is we don't recognize revenue without expense incurring some expense. So we need to recognize expenses as they happen to us. One thing to be cautioning yourself about here is that the amounts that we're recording, generally they're going to be based, in your case, on some sort of objective measure. This is our price. This is how much we charge per hour. Here's how much that part costs plus labor. Generally speaking, those things are pretty objective, but realize that if we're a company, we earned $50 worth of service revenue and we recorded service revenue on account, we'll go ahead and debit accounts receivable for 50. That's an asset. And that $50 represents what we expect to collect in cash. Is it possible that we might not collect the whole $50? Sure, people don't pay us back. That sucks. Life's a bitch, whatever. Expenses, revenues, we record them as the estimated amounts we expect to pay out for expenses and collect in terms of revenues. They may not always turn out to be that way. We'll talk about more of that later in other chapters. But in the meantime, we're going to accrue tax expense based on what we expect we owe to the IRS. Whether or not the IRS agrees with that is another story. But in the meantime, just realize that if we expect to pay out $70 to the IRS for taxes, that's just an estimated amount we expect to pay. Ultimately, and we'll get more into estimates later on, but any type of estimate requires professional judgment. These transactions involve people. And yes, we have good intentions, as do our customers and our suppliers. So we have good intentions. We have strong expectations. For sure, we're reasonable, but we also know that these expectations require professional judgment. We're trusting people with our business, and therefore that requires us to be ethical, and we need to impose ethical behavior on our customers and our suppliers. Ethics are always a consideration in accounting. A couple examples here to tie it off. So let's assume on September 1st, the car dealer, we're the car dealer. We sell a $10,000 car. The customer pays $2,000 down in cash, signs $8,000 loan, takes title to the car. On 9/5, September 5th, the car dealer receives $8,000 cash from the bank. When do we record the revenue? We record the revenue when it's earned, meaning we record the revenue when services are performed or when goods are delivered. Goods are delivered when title passes to the customer. So in that case, we record revenue on September 1st. That's when the goods are delivered. How much do we recognize at that time? Well, on 9/1, we're going to recognize the full 10,000. Why? Because on September 1st, the car was given and we represent the car's value was $10,000. We gave value of 10,000. What did we get in return? We got 2,000 in cash and we got another 8,000 cash later on. But for right now on 9/1, the dealer is going to debit cash for 2. That's the hard currency they got. They're going to debit, call it an account receivable from the bank for the other 8. That's a promise to receive. That has value as well. So overall, what did the dealer get? The dealer got 10K worth of value and gave sales revenue 10K in value. Something's given, something's received. But at that time, that's a fair value that was exchanged. We need to keep track of both sides of things. What about different values, different amounts? Let's assume an MSRP price on the car was $19,950. The dealer's initial price was somewhat less. A new advertised price in the paper was $13,500, and a competitor was listing the car at $15,990. What amount does the dealer recognize when it sells the car? Well, if the customer agrees to pay $13,500 and the dealer agrees to accept that as payment, then the amount that needs to be recorded is $13,500. That's the fair value that's being exchanged. That's how much we record. That's the fair value at the time. Tomorrow may be a different story. But for right now, we need to be very clear. In business law, in particular in the law of contracts and in the as reaffirmed through the universal commercial code, uniform commercial code, when values are exchanged, that's considered legitimate. Nobody can come in afterwards and say, oh, we don't have a deal, right? Contract law and uniform commercial code makes that deal solid. Those are all the slides I have. There is only 18 in this case, not 19. But if you have any questions, please let me know.